Hello and welcome to this latest edition of Courses on Demand brought to you by Forex Academy. In this course, we will be discussing trading psychology. Now, there is, of course, inherent risk when deciding to trade the financial markets. So just before we begin, please do take a moment to familiarize yourself with the following disclaimer. Now, the format of this lesson will be quite an interactive discussion indeed. Trading psychology really focus on your own perception to risk. We have things like fear and greed that perhaps dominate the sentimental analysis of financial trading and market participants as well. So we look to actually use these skills within ourselves to look at risk appreciation, to look to control our emotions, and to assess really the skill of taking losers with sentimental analysis. So as we begin, we'll learn to go through a quick discussion then of psychology as an asset to a financial trader itself. Well, it really has an impact on your state of mind, trading psychology. Achieving a state of mind that fosters successful trading is, of course, our approach to looking to educate students of the financial markets. And what we look to do, in our opinion, it is definitely more important to trade with a strategy that works. Otherwise, your mindset or psychology is not going to be good. So that is one particular facet to financial trading, particularly in the professional trading world, where traders look to devise a trading strategy, not because it simply works over a long sustained period of time, because it's a difficult job psychologically trading in financial markets. And if you can find a way of deriving or taking away some of the psychological factors that will dominate market participants and your trading, then of course it's going to benefit your trading over the long run. Most retail traders actually have poor trading psychology because of a poor trading strategy, and that's actually not the other way around. So it's not that they're trading poorly because of their strategy per se, it's because their psychology isn't in line with their trading strategy or doesn't permit them to perhaps take losers or perhaps even to get the most out of their winners. They're taking their winner trades too quickly, perhaps not letting the market give them a good chance to actually outperform when they do make very strong, correct trading decisions perhaps as well. So it's a bit of both, and we'll really go through this discussion through this webinar in terms of how psychology can affect your own trading as a retail trader. The question that I would like to pose is, do you want to be right or do you want to make money? Now, that might become a little obvious in terms of what we're trying to do here, not just with our education here at Forex Academy, but in actually approaching the financial markets as traders. Of course, we are in the business of making money. The reason why I posed the question is because there is a school of thought that many market participants are really, it seems they're more concerned with being right. And some people do share that sort of sentiment that they like a pat on the back. They like to add a lot of analysis to a trade, and when they're correct, even when they make money, they can say, "Oh, my analysis was perfect there. I made a fantastic winner, and I deserve a pat on the back." That's really not the case, or not what we're concerned with. We are concerned with simply making money, and that can actually feed into your trading in terms of putting too much effort into the analysis side and not focusing on what the market is actually doing. So the point we'd like to make here is it is important to detach your analysis, whether fundamental or technical, or perhaps both, from proper risk management. When you enter a trade, your ability to manage the life of that trade is just as important as all the decision-making skills that went in to justifying the trade itself. Okay, and there is a lot of traders that actually enter these markets with a trade decision. Perhaps fundamentally, they've put a lot of work into perhaps understanding the supply and demand function of the oil market. They've chosen to buy the market, and after a long period of research, the market actually doesn't do what the research has told them, and it starts to trade down. That is a difficult choice for the trader who has put a lot of work in really to this trade decision, and it becomes more harder to accept that not only as a loss, a financial loss in terms of trading, but to accept that you were actually wrong despite all the research. So that is the point that we want to make. We're not in the business of being right necessarily. We're in the business of making money, and we want to remain objective to our goals. Okay, so very important in terms of understanding the psychology of trading these financial markets. How does that necessarily relate to risk? Well, apart from risk as leverage in terms of what notional trade size we take or what lot sizes we like to take in these markets, we know that psychology has a very, very important factor in our trading decisions, both entering the trades and during the life of those trades more specifically. Many people believe financial trading is simply too risky and choose not to participate. Okay, there is, of course, inherent risk, and we know when speculating on price movement and trading these markets, but risk is more often a function of the amount of leverage or risk that we choose to accept. So it's not necessarily that these financial markets are so risky and that we can't trade them. When people, really novice traders in particular, decide to enter these markets not knowing what they're doing and funding accounts and taking on perhaps over leveraged or oversized trades, they're taking on too much risk, and it's not the actual market movement that causes these losers. It's the psychology of taking on too much risk as well. So let's highlight in some more detail. The truth is, the psychological factors of trading can actually easily be overcome by choosing an adequate amount of risk for each and every single trade position. This will ensure no loser is too great and no pressure is ever too tough to handle. And I realize as I describe this that this might become a little more obvious in its actual literature, but it's more often not the case. Let me outline perhaps an example. Um, a novice trader perhaps funds an account of 200 euros into a trading account and assesses the markets and wants to buy the euro dollar. For some reason, he has overcompensated risk and it actually moves 5 euros per pip. You can see that with a 200 euro account, a market that is moving 500 euros per pip, you're exposing yourself to the shortest of term of volatility, even if your trade decision is actually correct. That is not giving you much of a chance in terms of margin on your account. It's not giving you much of a chance in terms of the stop loss that that market provides. As we can assess, perhaps when that market actually moves back 20 pips, that's going to be 100 euros, which is 50% of your 200 euro account. So you can see the point that really I'm getting at in terms of psychology and risk, that if I choose to take that trade on, I've taken on too much risk. As that market moves against me, I'm really feeling a little uneasy in terms of the proportionate size that it has on my account and the risk I've taken on. And that is very much my own fault, not really ascertaining a good level of risk in relation to the psychology of the trade and to my account. So let's talk about controlling these emotions. And the question I would like to pose, or two questions really. First, let's have a hypothetical discussion. How would you feel if you made 100 euros in a trading day? Okay, if you made 100 euros in a trading day, I know that most of us would feel quite happy about it. Now that's absolutely fine. That's likely to be a good trade. 100 euros, perhaps of a small trade position, is absolutely fantastic. The second question I would like to pose really, and to get to the point, is really how would you feel if you lost 100 euros in a trading day? And obviously you're going to feel a little sad or disgruntled about that. Now, this is really the same function. Making 100 euros or losing 100 euros is actually could be the same trade, only the market moves up or down perhaps. The point I really want to drive home with this is that that should be completely objective. I know that most traders out there will actually make 100 euros and feel, oh, that's great. I made 100 euros, but kind of feel brush it off. It's okay, and try and push on. And that's more objective in its approach. But if you actually lose 100 euros in a trading day, you'll have much more sentiment to the downside, to be angry at yourself, to be, oh God, I can't believe I put that trade on 100 euros. I lost 100 euros in one trade. What did I do wrong? And start to ask these questions of themselves, where it's really the same. It's either 100 euros or it's 1% risk up or 1% risk down. So that you can see that there's an emotional factor clearly in these trading decisions. You can see that there is an emotional factor in actually how your account grows or pulls back from its profit. and that definitely has an effect in your overall approach to the markets. So let's attack this in a little more detail. Being emotionally attached to a single trade is a very dangerous state to be in because it often leads to wrong decisions and potentially disastrous outcomes. Okay, so if you have perhaps made two poor decisions that have overcompensated in risk in a row, perhaps like the last example, two €100 losers in a row, you're going to feel quite annoyed and you're going to want that money back. That can lead to potentially disastrous outcomes. We have another example here where a retail trader in a losing trade simply willing the markets to turn in their favor, and that can happen more often than not for the novice traders. Please come back. Please come back, willing the markets to turn around. You never want to get yourself emotionally into that position. We know that a market can remain illogical far longer than you or I can remain solvent. And this is a really, really important point to make when trading these financial markets and discussing controlling our emotions, guys. Because let's say we buy a market, we know that the news is really good, really supportive of perhaps the euro against the dollar, and the market for some reason decides to trade down. We don't know why. We know that the news again is very supportive of the market in question. Perhaps we're trading an equity market and we have had a Brexit decision or something really supportive of equity prices, and the market starts to trade down. The markets can, of course, be quite illogical in the short term, and they can actually, or far longer than you can remain solvent, than you can actually hold potentially a position open. So don't get yourself into these positions where we're willing the markets to come back and more assertive that I must be right on this trade. The markets can trade irrationally. We recommend that you do not become emotionally attached to any trade that you take. Don't pin all of your hopes and dreams on one market or one trade. And that's why this lesson is perhaps one of the most important lessons trading psychology. What you do get more often is one trade pulling back where a trader actually decides to say to himself, which is crazy in terms of a contrast to professional trading, okay, I can't believe the market is not giving me this winner. Everything is setting up fundamentally and technically. I'm just going to move my stop loss and I'm going to give my entire account until this market comes back. And what can often happen is the market does want to trade down and they wipe out a full account. So never pin your hopes on one particular trade. Giving 100% risk of your account to one trade is crazy stuff. Focus on the high conviction quality setups, and that leads us into discussing our technical analysis and actually looking to stack the odds in our favor so that we have high conviction in our trading and we look to those quality setups. So let's have a discussion on some of these emotions themselves. Fear and greed are the two biggest I suppose, emotional factors in terms of approaching the markets and entering these markets in terms of trading positions. So here we have from left to right, some what I would call popular illusions to trading. The Wolf of Wall Street. We can see the massive amounts of money that was made there in the stock markets. We can see how that may portray to many traders, particularly novice traders, again approaching these markets, that this is a totally ludicrous environment, and I want to get involved here and take big risks so that I can profit in the markets. Another one here, how to make $600 a day trading the markets. Well, that's certainly possible for some traders, of course, if they have very large account sizes or they have been trading the markets for a very long time and are very consistent at such a level. But to market that to the world, to new guys setting up accounts, perhaps with smaller accounts, that's going to be very difficult to make $600 a day. So it's not a realistic approach to your trading over a consistent period. You may actually, get to $600 in one day, 1 or 2 days in a row, and effectively blow up the account because you're taking a lot of risk. It's not a real, I suppose, representation of how we like to professionally approach our trading strategies in these markets. And then, of course, we have the laptop there where somebody is trading the markets and literally the CD drive is spitting out dollar notes. So it's just a popular illusion to trading. It can be ludicrous, these markets, but in terms of serving our fear and greed, is it the best sentiment to help us trade these markets? I would most certainly answer no. So Everyone has personal reactions to perceived or genuine threats. And that's not just in trading the markets. If there is something that you see as a threat, you're going to react differently to that. What response do you think fear elicits in a trader's mindset? Okay, so as somebody's trading the markets and they have a real approach to, oh, this market is very volatile, and perhaps I want to get involved because it could be profitable, but there's a lot of fear there. You're not going to be able to make the same trading decisions, perhaps, that you would, and that's why demo trading can actually be quite false in its learning approach, because, well, you're not actually involved in these fear decisions, or these real trading decisions. Fear can cripple a trader if they do not know what they are doing, and that serves us to discuss, I suppose, our education, and that's why we do these educations for our retail trading environment, and for our students who want to learn more, and obviously profit over a consistent period trading these markets. So you do need to, develop yourself with education. Everyone feels fear, especially starting out. It's normal, so accept it, contain it, and then use it to focus on your trading strategy and risk management approach. So, look, guys, it's totally normal to feel these things. Don't be approaching these markets, and when you're getting involved, thinking, I want to take this trade on, but I'm a little unsure, I'm a little afraid. If you've done your technical analysis and fundamentally have a little understanding on the market, certainly take the trade. Use your trade size to decrease the amount of risk that you're taking on the trade, but accept that you're going to involve yourself in these decisions. There's a little bit of fear there, especially for those who are starting out. I've been trading 11 years, and there's still some fear in some decisions in terms of uncertainty. So that's totally normal there. It is normal for traders to experience the effects of greed as well. You just won't realize it, okay? You might hear a little voice in your head saying, if I had just stayed in the trade a little longer, I would have made more money. Or if only I had moved my limit order to a certain level, I would have made more money. Oh, that's totally normal. And that's greed, in a sense that we want, of course, to overperform. These are normal thoughts, however, please don't let them consume you. Again, revert to concentrating on your strategy. So this is why we always talk about trading strategy here at Forex Academy. It brings a great level of objectivity to actually taking away the fear and greed in your trade management decisions as well. So let's approach this in a little detail. Here we have fear and greed. We're going to look at potentially trading these markets here, hypothetically, with some decision making skills. So here we have a long entry price above our level of support and resistance. Where do we decide to enter this market? Well, we have actually bought the market here at level 1. Perhaps we place our stop loss there. Then we can look to buy this at level again. As the market comes back down to the level, we have the same level of support holding. Perhaps we could again look to trade these markets 3 and 4 times. So we've potentially made 4 very good profitable trades here, and that would serve us to believe that our support line is holding, and we want to trade this level again. So we have the fantastic 4 here, and the question we want to pose is, we have just had 4 winning trades at the exact same entry price, perhaps. What are we likely to do next? Okay, so what are we likely to do then at this trading decision, just where we have the arrow there at our level of support? We're likely to, of course, to buy this market. We're going to make the same trading choice. So there is our buy. And another question that we can really focus in on in terms of controlling our emotions with this trade is, can a moment of greed affect your trading? And it certainly can. So we've just had 4 winning trades in a row. We're looking for a 5th trade. So there's an argument to say that perhaps we're being a little greedy with a 5th winning trade off the same level. We know technically, as technical analysts, that as these markets start to consolidate and the range or trading range becomes much more mature, the more likely or the more probable it is to actually break down. So can we be a little greedy perhaps in a 5th buy at the same level? I would argue certainly yes, but in terms of the position sizing, that is going to be your answer. So here we decide to actually take on this buy trade at our 5th level, and actually move our stop loss as the market moves down. We can see there's a break of the level. We decide to take away our stop loss because we don't want to take the loser. How are we feeling? What are our emotions feeling at this point, guys? So we're obviously feeling the effects of greed. We want more money from this trade. It's been working so consistently. The market has now broke the level. We don't want to take the loser. Here, the fear is entering the trade. So perhaps this is hypothetically something traders will do, and this is something we should never do. We decide to buy the market again, willing the market to come back to our level of support and resistance. Again, the market moves down. We decide to buy it again. This is called averaging in, and it can lead to absolutely astonishing losers. Then the market decides to go down again, and we decide, look, we can't we can't take this loser. It's just too great. Please come back to even a break even position so that we can get out of this trade. It's been a disaster trade after four good winners. Now we've overcompensated, we've been greedy, we haven't recognized the fear in our trading, and we're really doubling up on this trade and really taking on a huge amount of risk. Inevitably, what often happens is the market moves down again and we take our loser, which is an astonishing loser. We've given back all the profits we made from the first four trading positions to the upside from our support level. We've then overcompensated when the market has broken through the level to the downside. That should have told us that our level has been broken, um, and that we've decided to actually overcompensate with risk by buying this market several times, not getting any out of any of these positions. So terrible trading here. We can see how fear and greed really comes in physically to the trading platform, to trade management and decision, and can have such a negative effect. How are we feeling at this point? Still free money as we've bought the level four times? Most certainly not. A very, very poor trading decision, all as a result of not being able to control our emotions in this trade. So actually, when we assess risk management, when we assess trade management, this is a real skill that we need to control these emotions. It's a real skill to actually take losers, and that's often overlooked in professional trading, the skill to taking losers. So let's discuss that in some detail. We must recognize, of course, that losing is part and parcel of trading the financial markets. It is totally unavoidable. So let's just prepare for it. Let's be prepared. We have never met a trader that doesn't lose, and that is 100% truth. From all the years of trading, we have never met a trader who does not lose in the markets. It is important to know how to take a loss without it affecting your mindset. And those, if we decide to enter these markets, it's unavoidable. So let's be prepared for losing. It's just completely part of the game. So let's not affect our mindset. That helps us with our trading strategy, that we can stack the odds in our favor. So if we make 100 trades over the course of perhaps a few months, those probabilities are going to shine through and we're going to be profitable. Those losers we can shake off, and we should not let it affect our mindset. We prefer to lose small and win big, so that refers obviously to this skill to a positive risk reward ratio. There's a skill to taking those smaller losers. This is why having a comprehensive trading and risk management strategy really comes into play. It really comes into its own. If you are fundamentally set up to lose small and win big, you immediately have a trading edge. And that should be something we are all familiar with in terms of trading in the financial markets, where you hear traders, I have a trading edge, I'm trying to develop a trading edge. That in itself is a trading edge if you have an adequate, well-performing risk management, um, positive risk reward ratio, where you become more objective to your strategy and you're fine with taking losers. Then the winners will always come, of course. So here we have a bit of a practical approach to actually trading the markets, and I want to outline two charts to you, or two views on the charts, I would say, in terms of the skill to take these losers in the financial markets. Here we have the S&P chart in front of us, the price action chart from left to right. We're looking to buy this market. Okay, where do we look for these buying opportunities? Well, let's just outline one potential opportunity and how we may trade. So here sort of around January time, we decide to buy the market with a long market entry, the first thing that we'll need to do in terms of developing our skill to taking losers is, of course, place our stop loss. So we place our stop loss at a technical level, perhaps below the recent candlestick, so that the pricing structure there is giving us enough room to allow some volatility, but for the market to move to the upside. So that's good. That's the first thing that we do. We've entered the market. We've As we enter the market, we place our stop loss. Now, inevitably with this trade, the stop loss, the market moves up, and so we can actually look to move our stop loss higher. That is a skill, not just in taking the loser, but that's actually looking to protect your capital. Probably that's the best way to say it. We've moved into a profitable position as the market has moved up, and so we can actually look to capture that profit if the market pulls back. We still want to remain in the trade if the market continues to go and move in our direction. However, we're looking to mitigate risk on the trade by moving our stop loss into a profitable area within the market. What would be the alternative to this? It would be poor risk management, not a skill at all. Would be if this market traded up and then traded the whole way down, as we can see that it did, perhaps 1 month later. We actually take a loser on a trade because we didn't mitigate that risk as the market continued to move up. We can't let these trades come the whole way back. But this is a good example of actually buying the market, following risk management, and the skill to really look to protect your capital. Now, as an alternative, let's look at really the skill to taking the loser. Well, the question that this market or this trade poses, perhaps, we've already made the trade to the upside. We can see there's a sell-off. Perhaps our analysis for some reason tells us that we want to buy the market at this price. We place a long market entry here, and then the first thing that we do is place our stop loss, of course. So again, the question, are we able to act in the same way? So just because the previous market, we actually bought the trade, we placed the stop loss and the market moved up, we left our stop loss there. We actually moved our stop loss into a profitable position um, to mitigate risk. Should we be looking to mitigate risk on this trade, or should we move the stop loss in any way? The answer is certainly not. If our analysis tells us that we have entered the trade and the stop loss is there because we don't want to get stopped out of the market, but if we are wrong, we should not be moving the stop loss lower, and that would be very, very poor trade management. So there is a skill. This skill is in itself discipline. The discipline to keep this stop loss where it is, so that if the market moves in our against us in our unpreferred direction, we're able to objectively take this stop loss and take this loser as it moves. So hopefully we're able to use this skill to actually react in the same way when trades are performing or not performing for us. This builds in then to actually analyzing these markets with sentimental trading and analysis. Again, we have the same price action chart here. I just wanted to keep this because we can see the US equity market sell off February 2018 there. What emotions were traders feeling during this market? And I wanted to finish off our lesson here with really discussing the sentimental side. We know that we have fundamental traders in the markets. We know that we have technical traders in the markets. And now we know we also have sentimental traders. They're trying to really ask and answer the question, whom is in control of these markets at any given period? So that leads us into discussing, emotions. Can we control the emotions given that there's a school of thought or market participants that only trade based off these emotions? How is the sentiment performing in the markets? Obviously, as we look from left to right, we can see for a long period that the emotions or the sentiment analysis was to the upside. Okay, the bulls were in control. That just shifted there February 2018. So that would put to question your own emotions of your trade. You believe that there's still a bull market, perhaps in the equities, particularly the US equities. Just trying to buy on that basis without no technical analysis, or giving it a very wide stop loss just because you think that the markets are going up. When we see the price action, we know that the sentiment has changed, and our analysis should, of course, change to reflect that. So this is something we want to tie in to our trading psychology and our emotions in terms of controlling those emotions to actually look at both our fundamental technical, and sentimental market participants in judging how we can best trade these financial markets and remain objective with our approach and analysis. So that concludes our webinar there discussing trade psychology. Let's review our lesson indeed with this course on demand. The psychology of trading, we discuss it in and out with its approach to risk. We discuss controlling our own emotions as, look, we're only human beings. We need to develop and practice our own emotions in regards to trading these markets. Fear and greed are the dominant factors and perhaps swaying those emotions as the markets really cause some volatility. And how we can look to combat that is obviously through our own element to risk appreciation and our own appetite for that risk. Perhaps if we are observing that we're becoming a little greedy in the markets or a little more fearful in our trading, then we should cut way down on our risk. We discussed then that the skill to taking losers, it is actually a very well defined skill that is often overlooked. You know, not in actually approaching these markets for profitable trading positions all the time. We know that we will have losers, but there's as much skill in taking small losers as there is in taking those winners out there. So that is very important to understand, and that ties in nicely to sentimental trading. We know that, look, you know, bulls and bears control these markets. That's a sentiment approach in terms of whom is control of the markets at any given time. That feeds into analysis and it builds the bigger picture of how we can control our trade psychology in approaching these markets. So that concludes our webinar. Thank you very much for joining us on this installment of Course on Demand, brought to you by Forex.Academy. We do hope to see you very soon. Bye for now.